Hi, my name is Danny Brown. I'm the CEO of Myriad Real Estate Group, and this is going to be our August market update. So we're in the doldrums of summertime here in Phoenix, and it is ridiculously hot outside. And so when the temperatures are in the triple digits, we typically see a pullback in market activity, and this year isn't any different. Compound on top of that, interest rates that are hovering around 7%, and buyer demand has really started to pull back. I do think that buyers are kind of used to these higher interest rates now, with rates being in the sixes, but there is something about having a mortgage rate with a 7 in front of it that puts the brakes on everything. So this last week, towards the end of July, we have seen interest rates pull back a little bit and fall back down into the mid to high sixes, which is where they've been for the better part of a year now. With these higher rates, a lot of people were predicting that home values would start to come down. The complete opposite is true. We saw a dip in home values towards the end of last year in 2022, but this year we have seen home values steadily increase the entire year. So on average, we've seen home values go up about 4% across the country. And if rates do come down, I think that that trend will continue and we could see home values pop even more. I'm recording this video towards the end of July and the Fed has not met yet, but across the board, everybody's in agreement that they expect Jerome Powell and the Fed to increase the federal funds rate by another 25 basis points. Then they're going to be paying attention to the words and the terminology that Jerome Powell uses during his press conference to try to forecast what he is going to do in the future. So the Fed is not meeting in the month of August, so the next Fed meeting would be in September. So will they raise rates again in September? Will they pause? Will they skip? Those are kind of the questions that everybody's going to be looking for to try and answer. So without a doubt, Fed's going to increase this week. The market's already baked that in, so we shouldn't see too much in terms of reactions. If we see conversations or language come out of the Fed, rather that they are going to pause or they are done with rate hikes, which is what I think that they should do, then we will start to see, I think, mortgage rates come down, a lot of market volatility will disappear, and things will really start to calm down. And the reason that I think rates will come down is we will start to see the spread between the 10-year Treasury and mortgage rates narrow. It's the widest it's ever been and nowhere close to the average that it's been over the last 20 years. And so that mainly has to do with all the market volatility. Will he, won't he, will they skip? Like, we just don't know. So that spread has been baked into rates for a very long time. So once we get to the end of the Fed rate hike cycle, we should start to see mortgage rates back off. So we are very much closer to the end of the rate hike cycle than the beginning. And, with the Fed hiking rates at the end of July, I'm hopeful that he will be done. We saw very favorable inflation numbers come out this month that were better than expected, showing that all of these rate hikes and that everything that's been happening is working. Inflation is coming down. And so what they can end up doing if they continue to hike when they don't need to is they can actually put us into a deflationary period, meaning that inflation comes down extremely rapid and then they overshoot their target, which is 2%. The Fed wants to see inflation at 2%. This is just an arbitrary number that they've made up. There is no real reason why. It's just that over the last 20 years, inflation has been at 2%. So that's what their target is. But it's not a rule. It's just an arbitrary number that they decided on. I think that if they're okay with a little bit higher rate of inflation of around 3%, which is where we're at now, we will be able to orchestrate what's called a soft landing, meaning that we may not go into a full-fledged recession. Now, the Fed feels very much like they can be aggressive because the employment market really hasn't pulled back during all of this. The United States economy has proven very resilient. We have not entered into a recession yet. However, some experts talk about rolling recessions, like the housing market has been in a recession for over a year. Some other areas within the economy have also been into a recession, but it's not a recession across the board where GDP has been negative for multiple quarters in a row, which is one of the defining things of a full-fledged recession. So I'm hopeful that the Fed will be finished after this month. I know I've been saying that, I feel like a broken record, but I don't think that they need to continue to hike rates, because some of the things that they're trying to control and impact, you just can't control with continued rate hikes. So even with these higher rates, home values have been going up across the board. And again, it just really comes down to supply and demand. The supply of homes has remained very low for a very long time, and even though demand is depressed, it is still outpacing supply. So when there's more people to buy a product, regardless of how expensive it is, the price of that is going to be pushed up, and that's what we're seeing. Typically what you want to see in a housing market year over year in terms of appreciation is somewhere in like the 4 to 7%, maybe 8% range year over year. Well, for the first 6 months of this year, we've been at 4%. So that's still higher than a higher rate of appreciation than what is really healthy for the housing market. So home values are still going up faster than what we'd like to see. What can crash the market, or what can cause home values to come down or make affordability, bring affordability back, would be if the Fed continues to hike rates where they break the labor market and cause unemployment to skyrocket. Now, if unemployment goes up, people still have to live somewhere. They're not just going to automatically go to foreclosure, but they will start to list their homes. If they can't afford their mortgage that they're in, or if they own second properties, third properties, investment properties, Airbnbs, you could start to see an increase in inventory, which when you have depressed demand and increasing supply, that would bring home values down. I don't necessarily think that we're going to see that. Even if we see unemployment go up by 1 or 2%, we're still within the range of what would be considered normal. Right now we are below normal with unemployment at about 3.6%. So my prediction of what we are going to continue to see is that home values are going to continue to go up. And if mortgage rates start to fall, and as they get into the lower 6s and then eventually hopefully into the 5s, all bets are off, and I think that home values could be on a runaway trajectory to the upside. We can go back to the end of last year where home values were actually coming down in the months of November and December, and that was mainly, supply was increasing, demand was falling. Compound that on, we're in the holidays when the demand for housing is low anyway, and we actually saw home values come down. I can show you a graph. It is not a crash. It is a minor correction. It's a little blip where home values came down just a few percentage points, and then after we got through the end of the year, started its upward trajectory. So be very careful about what kind of language you're paying attention to. There's going to be a big difference between a crash in the market and a correction in the market. And a correction in the market wouldn't necessarily be a bad thing. But I'm not even predicting that there's going to be a correction in the market. I just think that there's too many people wanting too few homes. That's really what it comes down to. So what can sellers expect as we continue to move through the summer months here in Phoenix? Well, the second best time to be a seller or to be in real estate in Phoenix is going to be August, September, and October, and then the first half of November. So kids are starting to go back to school. I don't know if you've noticed in your news feeds that everybody's taking pictures of their kids going off into whatever the next grade is, and we can see that kids are back in school. So that means less vacations and just more people are in town and getting back into their routines. So whenever that happens, we do see an uptick in market activity. So I think for sellers, there will be buyers out in the market from now through probably Thanksgiving. So if you're looking to sell your property, that window of time is the second best time to be a seller, next to the springtime, which is about mid-January through early June. So in terms of market timing, you're looking really good for this fall. Buyers, what can you expect? Well, there is not a ton of competition out there still. Again, I keep saying that buyer demand is depressed, and that is true. And so it's a tale of two markets. If a home is priced accurately, looks fantastic, is new to the market, it's probably going to have multiple offers on it, and you're going to have to be a little bit more aggressive in what you're willing to make an offer on that home for. If the home has been listed for a few weeks, if not a few months, then you can be more aggressive in your offer to try to get a deal. You can get the seller to cover your closing costs. You can negotiate on the price. You can absolutely get them to do repairs. So it really kind of depends on the situation, and this is where your agent is going to come in really handy in asking and reaching out to the listing agent to find out more details about the home and if they do have any other offers and what the interest has been in the home. That way they can give you a better idea in how aggressive to be on your offer in terms of trying to get a really good deal or coming in closer, if not above the list price. All right, thank you so much for watching our market update for August, and we will see you next time.